Hello and welcome to this week's Market Minute. It's a new year, it's a new political environment, all kinds of questions, some excitement, some uncertainty. So let's first take a quick look back at last year, and then I'll give you some thoughts heading into this year. So looking at last year, I want to take a look at the benchmarks, the indices, as well as our performance and strategies and how the all-weather mark did this year or last year. So looking at this chart, what you'll see is the top blue line is our aggressive strategy, taking advantage of the all-weather model behind it, which is up about 18.7%, versus AOA is the S&P aggressive benchmark, was up about 13.55%. So it was a great year, good year for the market, and better year for our performance because the all-weather score kept us aggressive. In fact, you could see that with the aggressive benchmark being up 13.55, our moderate portfolio was up 13.92% last year, that purple line. And similarly, while our conservative model was up 7.79, the conservative benchmark was up 6.57. So again, our conservative was about in line with a moderate benchmark. So a good year for us. We're not always going to press the market by that much, but we'll enjoy it while we can. I want to talk to you about really what I've been talking about the last 15 years. I set a long-term course of what I expected, going back to when really we had the last economic bubble burst and corporations had to cut their spending. They started hoarding cash and eventually started spending that money on research and development, which is finally paying off. And I think will continue to pay off in a very big way over the next 5 to 10 years. So let's take a look specifically at CapEx spending by the major AI artificial intelligence spenders. That's Alphabet, Amazon, Meta, Microsoft, Oracle. Now, what I want you to take away here on this left side of the chart is that just over the last 4 years or so, since the beginning of 2020, we've seen that spending almost double from $73 billion, now above $120 billion, approaching $150 billion. That's dollars. Now, percentage-wise, as a percentage of their operating cash flow, it's also doubled from about 20% up to 40%. Now, that sounds a little bit out of control, maybe even a little bit uncomfortable. But what we see historically is when spending like that occurs, it eventually pays off in revenues and ultimately profitability. So I'm very excited about what that's going to mean for things like medical, education, transportation, all areas of our lives, which is going to trickle to profitability, corporate earnings, which means the market's going to go up, the job market's going to continue to improve. I do expect some bumps along the way. In fact, I expect some bumps in the next couple of months as things transition and there'll be uncertainty in the markets. And there's always going to be some downturns along the way. However, I'm very optimistic about how this research and development and spending, not just in artificial intelligence, but all areas of technology, is going to pay off and drive the markets. So hopefully we can enjoy the ride together. Let us know if you have any questions. Check us out at wealthyp.com. We'll see you soon.